The math is simple, but the consequences are enormous. For over a decade, the world's most powerful governments assumed interest rates would stay near zero forever. Borrowing became cheap, debt expanded, and the system grew dependent on easy money. But that era is ending, and now global debt is colliding with rising interest costs. When the math stops working, governments don't just face inconvenience, they face structural pressure. Today we break down why governments cannot afford high interest rates forever, and what happens when the money runs out. To understand this, we have to return to the era after the 2008 financial crisis. Banks were unstable, credit froze, growth collapsed, and the world faced a historic shock. Central banks responded by slashing rates to near zero and injecting liquidity into the system. Borrowing became cheaper than ever, markets recovered, and governments began spending at massive scale. But quietly, debt didn't just increase, it became necessary for normal life. Governments began funding ordinary budgets through borrowing, not just emergencies. Over time, the global system became addicted to low rates, like oxygen that couldn't be removed. This is where the sovereign debt trap begins, when debt grows so large that small rate increases become dangerous. This is not financial advice, just an educational breakdown of how macro pressure builds inside the global ledger. Most people think governments pay off debt, but in reality, they roll it over continuously. Governments refinance old bonds by issuing new bonds, and debt is rarely eliminated. This creates a refinancing risk, because debt doesn't disappear. It simply reprices over time. When rates were low, refinancing was painless. But when rates rise, the structure changes completely. Debt becomes heavier, not because the number grows overnight, but because the cost of carrying it rises. This is the first crack in the system: interest expense. Imagine a government with $30 trillion in debt. At 1% interest, servicing costs are around $300 billion per year. That is already enormous, but manageable inside a large economy. Now raise rates to 5%, and eventually that same debt costs $1.5 trillion per year. Nothing new is built. No roads, no hospitals, just the cost of existing. Interest becomes a gravitational force pulling the budget backward. This leads to the crowding out effect. Governments have limited revenue, and interest payments begin consuming larger shares of budgets. Leaders face impossible choices: cut services, raise taxes, or borrow even more just to pay the interest. When borrowing is used to service old borrowing, debt begins funding debt itself. This is how sovereign traps tighten, not through drama, but through arithmetic. Debt stops building the future and starts preserving the past. The third mechanism is even more underestimated. High rates don't only hurt governments, they hit the entire economy. Mortgages become more expensive, business loans tighten, credit card debt grows heavier, and private borrowing slows. Consumption weakens, investment declines, and growth cools. When the economy slows, tax revenue falls at the exact moment interest expenses rise. Governments get squeezed from both sides, rising costs and falling income. At this stage, the question becomes unavoidable. How do governments respond? Spending cuts bring austerity, but austerity brings political and social consequences. Higher taxes have limits, and borrowing more becomes expensive. The remaining option is central bank intervention, and this is where monetary credibility enters. When debt becomes too heavy, central banks face pressure to cap rates. This creates the core dilemma of the modern era: fight inflation with high rates, or protect debt stability with lower rates. Both choices carry risk, and governments cannot balance this forever. High rates expose the debt burden, while low rates expose the currency. This is the trap, and it is structural, not political. Now zoom out, because this is not one country, it is global. Debt is everywhere, and interest rates are the global price of money. When rates rise in major economies, the shock spreads outward through currencies, capital flows, and trust. Currency trust is often the first domino. If investors doubt affordability, confidence weakens, and capital begins to leave. Exchange rates fall, import prices rise, inflation accelerates, and pressure increases further. Currency crises begin not overnight but through slow erosion of belief. Emerging markets are often the first to break. Many borrow in foreign currencies, especially US dollars. When US rates rise, the dollar strengthens, local currencies weaken, and repayment becomes harder. The debt did not grow, but the currency shrank, making obligations feel impossible. This is why global tightening cycles trigger crises abroad before they reach the core economies. Stress travels faster than headlines. Then comes the social dimension. When budgets are consumed by interest, governments cut services. Pensions shrink, healthcare strains, infrastructure is delayed, and living standards come under pressure. Austerity is not just economic, it is political. Social stability weakens when governments can no longer provide because debt service dominates budgets. This is why high interest rates cannot last forever. The system reaches limits not only financially, but socially. When societies feel the consequences, political pressure rises, and emergency measures become permanent. Liquidity becomes selective, volatility becomes normal, and confidence becomes fragile. Bond markets begin to demand higher compensation, and the trap tightens further. This is not collapse, it is constraint. So what should we actually watch? Not predictions, not headlines, but signals. First, yield curve control. Central banks artificially cap rates. It means debt is too heavy at market prices. Second, the pivot. Watch when central banks stop fighting inflation because the debt burden becomes unbearable. Third, credit rating downgrades. When stable nations get downgraded, the trap is snapping shut. These are stress indicators, not guarantees. Governments today are walking a razor's edge. They must choose between fighting inflation with high rates or preventing debt instability with lower rates. The math suggests they cannot maintain this balance indefinitely. High rates break budgets, low rates weaken currency trust, and both paths carry risk. This is the sovereign debt trap. Understanding these mechanisms is the first step toward resilience in an era of financial system stress. This content is educational only, not financial advice, not investment guidance, and not a prediction. It is a breakdown of how the system works and where pressure builds first. Debt does not destroy systems overnight, but it limits options over time. And when options disappear, history changes direction quietly. The next episode, we go deeper, because debt is only one pillar of global stability. The other pillar is currency, trust, and the reserve status of the US dollar. What happens if the dollar begins to lose dominance? Happens to trade, savings, and the global order itself? That is the next shock scenario, and we break it down next. The world is running on debt, but debt only works while trust remains intact. Interest rates are the price of that trust, and rising rates reveal the burden underneath. This is not about panic, it is about understanding structure. Because systems do not fail from one event, but from accumulated stress. And governments cannot afford high rates forever. The era of easy money shaped the last decade, but the era of expensive money reshapes the future. Debt becomes heavier, refinancing becomes harder, and budgets become trapped. The bond market becomes the pressure gauge of the entire system. When the gauge rises, flexibility disappears. And the first thing that breaks is not the debt itself, but the ability to carry it. This is the math behind the sovereign debt trap. This is why interest rates matter more than headlines. And this is why the next phase of the global economy will be defined by constraint. Watch the signals, understand the mechanics, and stay aware of systemic stress. Because the next shock will not come from nowhere. It will come from pressure already building.